Welcome back to the channel. A lot to unpack this week, especially when we talk about variables, fixed rate mortgages. What options are best suited for you? And asking some of these really serious questions, especially as people are chasing those lower rates. Do I take a longer term? Do I take a shorter term? What are my options? And as we see some changes and a shift in the rate environment, ultimately that answer can become a little bit easier. But I want to take an opportunity this week and unpack our thoughts and opinions, the conversations that we're having with our clients surrounding fixed and variable rates, especially as they approach mortgage renewal or looking to venture off and purchase their first home or move up to a larger home. So welcome you back to the channel. It is Friday, Finance Fridays. Once again, I'm your host, Anthony with In Touch Mortgage Solutions. Do us a favor, if you have not subscribed to the channel, consider subscribing, hitting that notification bell, as well as don't forget to leave those thoughts, questions, and concerns in the comments section below, and give the video a thumbs up. Helps the YouTube algorithm. Now, let's get right into this conversation. As the interest rate environment continues to shift, as we wait for the next Bank of Canada rate announcement coming up on September 4th, as well as another rate announcement from the US, the highly anticipated potential cut coming out of the US. We do believe that that will move the needle for a lot of the treasuries, the bonds, right? Ultimately, as a quick recap, we understand that fixed rate mortgages are tied to what is happening in the bond market. The 5-year Bank of Canada bond, in simple terms, is a good barometer to gauge what is happening with fixed rate mortgages. But if we look at the Bank of Canada, when it makes its decisions on their policy rate, that directly impacts variable rate mortgages. Anything that is tied to a variable rate, whether that be a mortgage, a line of credit, or some type of adjustable loan, a lot of times that will move with what's called the bank's prime rate. So as you may recall, we've talked about this on the channel before, but the prime had gone from 7.2 all the way down to basically 6.70% right now. And when we start to look at the potential, if you're thinking about, hey, what do I need to know about a variable rate mortgage? Why would I take a variable rate mortgage, and sort of what type of people or what type of clients are looking at variable rate mortgage? I think this is a very interesting conversation, and one that, as I said, we want to share with our viewers as well as our clients. Now, if you are considering a variable rate mortgage, right, you have to understand the volatility, right? We've definitely learned, we've seen over the past little while, a lot of news about banks and their types of variables, those trigger rate mortgages where the payments remain static, and the only thing that changes is the principal and interest calculation, as opposed to true adjustable rate mortgages where you would have felt those pressures, whether they would have went up or down, whatever the Bank of Canada decided. Now, with the fact that we are potentially in a cutting cycle, the question is how low will we see these central banks go? And that is ultimately what a lot of Canadians who are a little bit more risk on are expecting these central banks to cut significantly, right? We don't have an answer to where they will end up, what the final resting policy rate will be for the central banks. It obviously depends on the strength or weakness in the economy. Remember, the central bank will look at inflation, inflationary targets, getting that number back down to that bandwidth of 2%, and ultimately what happens in the employment or unemployment sector, other factors to consider. If you're one of these individuals that are very risk on, and ultimately depending on the size of your mortgage, I think this is a really important conversation. If you believe that the central banks are going to be cutting, and you think that they're going to be cutting significantly based on your own research and data, then a variable rate mortgage may be an option, because you are able, with a true adjustable rate, one that moves in conjunction with the lender's prime rate, well, then you're able to take advantage of some of these discounts, right? If we see 0.25% cuts in potentially September, maybe, other subsequent cuts in the following year in 2025, that is an option, right? That is something that many are considering. A lot of them are leaning to the lenders that are on adjustable, keeping in mind that some are not all variables are created equal. So we have to understand that. Ultimately, it's the size of the mortgage when we're having this conversation with our clients. I mean, if you have a substantially large mortgage, you may not want to take on that additional risk. So if you're thinking about it, right, let's say you have a variable rate mortgage, prime is at 6.7%, you were able to get a very good discount. There are lenders that are offering some significant discounts. We'll do a rate update very shortly as these rates continue to settle. But let's say you're able to get a discount of prime -1, so prime being 6.7 down to 5.70%. That's a very decent rate in this environment, especially when we've come from the sixes, maybe even sevens for shorter term products. But ultimately, you might be able to get like a 3-year fixed mortgage for under 5%, depending on the type of qualification, if it's insured, insurable, if it's a purchase. So you have to understand the spread between that particular rate. It could be, hundreds and hundreds of dollars. And, when you think about a variable rate in this environment right now, it's probably, you're looking at around an additional 0.25% cut in September. That additional 0.25% cut every time the Bank of Canada cuts, it's generally around $15 to $16 per every $100,000 mortgage. And as we continue to show our clients the spread between a fixed and a variable, you have to be able to stomach that spread and hold the line to think that, hey, in the long run, will the Bank of Canada's, will my forecast, will my thesis play out where that rate's going to come down significantly enough where I'm actually beating that 3-year product? And that is literally the disconnect sometimes when we're having that conversation. But ultimately, we're not here to push anyone in either or direction. We always let the numbers speak for themselves. And I think that's an important part of this conversation, is doing the research, doing the due diligence, understanding what your budget, what your household budget, what your income looks like. And if you're really interested in finding out more about that, ultimately you can reach out to a mortgage professional, or you can download our app in the description box below. It is free, and you can play around with the numbers. You can start looking at how those numbers look like if you start adding in additional cuts. If you want to run that scenario, say, hey, I think the Bank of Canada is going to go from 5.7 to 4.7 by some point, that the actual prime lending rate is going to go from 5.7 to 4.7 in the next 6 months, 1 year. But once again, it comes down to the mortgage size. A lot of the time we're having that conversation with the client. It's very important to understand a few things about their income, their stability as we enter into this very volatile time, especially with a lot of individuals concerned about their employment. Like, what type of work do you do? Have you been recently hired by the company? Would you be the first person on the chopping block if that company starts to downsize? These are the questions you need to ask yourself, and ultimately looking at those particular nuances is very, very important, because fixed rate mortgages, as we say generally, they are a peace of mind for a lot of Canadians who have now looked at the market and said, okay, well, I took a 5-year fix before, I'm approaching a mortgage renewal in the next few months, what do I do? And a lot of clients are taking the shorter term products because it gives them that flexibility to look at the future and say, okay, I think that fixed rate mortgages are going to drop. I'm coming up for mortgage renewal in the next little while. I don't have many options, right? We're going to ride out that maturity right to the bare end of it, right to the last day. And that is an interesting part. Just want to really emphasize that, because it's really important. If you have a fixed rate mortgage that is substantially lower than the current rates that are being presented to you at renewal, do not sign back that mortgage renewal early. Let those few months ride out. Let those extra few weeks ride out, right? Make sure that that mortgage renews on the renewal date. A lot of times clients may panic. They may say, hey, I need to renew now. We've had clients that were approached 6 months ago with a mortgage renewal, and against their judgment, or they're calling us afterwards saying, Anthony, we signed up, what can we do? Can we shop around? I'm like, yeah, we definitely can. But if you've renewed with that lender, you're sort of stuck, right, in that particular rate. So, and especially if you have 3 months left, you think about the spread. Let's say you got a rate that was under 3%, and now you're renewing with a rate that starts with a 5. Well, that's a huge loss. You don't want to do that. So making sure that if you have a renewal, it's a good little piece of advice. Wait till your mortgage matures. All our clients that we're doing renewals for right now, we're setting that closing date to be the exact same day as the day that their mortgage would be coming up for renewal. Even if it's on a weekend, obviously you do a day before, a day after. We're figuring it out for our clients. But you also want to make sure that you're selecting a lender at renewal that's going to benefit your needs. Whether you're going variable or fixed, you should be really paying close attention to the next few years in your mortgage and home ownership journey. If you have accumulated some debt over the course of the past few years, what are my options to refinance that mortgage, reset that amortization maybe up to 25 or 30 years. And yes, if you do increase your amortization, more money will go towards interest than towards principal. It is a very common sense thing, right? We understand that. And for some clients, it's ultimately about cash flow. You have to understand your position. If you're already struggling right now and accumulating debt, how much is that debt costing you? How much is the interest rate on those credit cards, those lines of credits, as opposed to locking it into a mortgage? Yes, you're amortizing over a longer period of time. At the end of the day, it comes down to cash flow. Interest in the bank to the bank is something that nobody wants to forego. We don't want to give money to the banks. They already make enough. But you also have to look at your family and your family budget. And for a lot of clients, when we're presenting them with keeping their amortization the same or extending it, understanding the interest cost difference on what's going towards principal and interest, some of them are just saying, you know what, Anthony, we need that extra relief. We're going to do a 3-year product. At the 3-year term, maybe consider refinancing that mortgage back down to a traditional 20-year, wherever they would have left off at, and then be able to absorb those payments at potentially a lower rate in 3 years or 4 years or 5 years from now. And this is really the conversation when you're speaking with a mortgage professional who understands and is looking at your financial situation. I mean, that is a huge difference. We get a lot of calls from people, a lot of clients, that they just never thought of it in certain ways, right? Because they walk into your traditional bank, they're just sort of presenting you with the option. You're not looking at all the different aspects of it, fixed, variable. What other things are you considering now that your mortgage is coming up for renewal? You're looking at that variable. You have to understand when we're talking about variable rate mortgages and fixed rate mortgages, those penalties, right? Variable rate mortgages, 3 months interest, right? You're paying 3 months interest on that particular mortgage with most major banks. There are some that are a little bit on the outlier. They outlie on the other banks. Some of them use the discount rate to qualify that penalty. Some will use the prime rate. Obviously, there's a spread there. That can be additional thousands of dollars of penalty, so understanding that. But then there's the fixed rate, which if you're breaking out of that mortgage prematurely, what is it going to cost you to get out of that mortgage? And that is literally the question, because as you look forward to the next few years, if you're taking a 3 or 5 year variable, do you need a line of credit? Does your lender offer you a line of credit? Do you plan to do any renovations? Do you plan to maybe take out some money to plan for your children's future? Is there anything that you're going to need some money for, especially if you're locking into a mortgage? When you hit mortgage maturity, that mortgage renewal, you become almost like a free agent where you're able to shop around. There's lots of lenders that will do switch and transfers that will cover pretty much the entire cost of that potential switch and transfer. To bring you to a different lender, we can add in potentially lines of credits. We can give in those extra features. There's so many different things to really consider. And I think the important part is when you're looking at fixed, you're looking at variable, you have to really understand what the options are. What is your future plan? I think this is the conversation. And recently we were interviewed through NerdWallet. It's a very interesting publication, online provider of a lot of mortgage and credit card information. And they reached out to us to have that conversation on mortgage renewals and sort of the ideas that we present, how we separate ourselves from a lot of other people in the industry. I think this is a really important conversation, and understanding, your qualifications, your budgeting. Download the app in the description box below. That play around with your numbers. And one thing that I did mention in that conversation with NerdWallet is run it in 2 different scenarios, right? To understand one very important thing. One super, super important thing is when you're going through the mortgage process, the major banks, most banks, actually all banks, I should say, they use your gross income to qualify, especially if you're salary or hourly. They don't use your net income. So what does that all mean, right? Well, when you think about it, if you make $100,000 a year in a salary position, let's just say, well, what is left over after you've paid the taxes, right? After you've paid CRA, after you have the deductions that you've been paying to your payroll, what are you actually taking home? And this is a super interesting conversation, because if you start running the numbers on your take-home income, you'll start to realize, hey, this is exactly how much money I'm left over. You're paying your mortgage with after-tax money. You're not paying your mortgage with pre-tax money, right? So you need to really run those scenarios when you're looking at your debt load. Just because you can qualify, especially for those that are going out there to buy, we always run that scenario to say, look, you do qualify with the bank based on the net income, but what does it really look like when you're qualifying on your gross? Because for us, when we come to renewals and refinances, a lot of clients, especially when they have children, They forget that once you go off work, one person that is going to be off, they're going to not be getting 100% of their pay, not in all professions. They're going to be getting a pullback, right? They're going to see maybe 60% of their income with a top up, or depending on your employer, how you're going to get compensated, some not at all, especially for self-employed. So you have to really factor out, you're going to have potentially, if you have children, more mouths, less income equals potential for higher debt to incur, because you're basically trying to, offset that additional income. So always do your due diligence. If you have questions about your mortgage, your renewal, you're looking to shop around, obviously feel free to reach out to us here at In Touch Mortgage Solutions. We'll definitely be happy to have that conversation with you. But let us know your thoughts on the mortgage environment right now. Do you think that interest rates are going to move? Or think we're going to see fixed rates come down? Let us know your thoughts, questions, and concerns in the comment section below. I will leave the video here, wishing everyone a wonderful Friday and an even better weekend ahead. Thanks for stopping by.